if you take the rules that I gave you and simply hit market rewind on TradingView, you just need to literally ask yourself a yes or no question to the rule set. Do we have a confirmation candle? Has price hit a half standard deviation? And then you get to nerd out on some data. You get to try and read mode and median extension and retracement levels. Mode is the biggest bar within the data set, and the median is what number is provided to you at the top of each box. You would start with those. There's ways in which we take those counts and we deduct them and we map out probability, and there's levels to the game. Your first step is to focus on the mode, the biggest bar, and the median, the number that's provided to you. So your mode and median retracements, and if you're unsure of how to utilize that, Captain Matt Mickey is doing a very good job of making clear, concise, very short videos. DR Lens, there's an orientation for that as well by Medj within the orientation of the Academy. And most all of our information is cooked in within this Discord, but I am quickly trying to extrapolate it with a production team and trying to add more official kind of coursework as we did today, looking at indicator settings, why that matters for framework, this model and its rule set, where and how it plays out. The goal, though, is, Lewis, to really answer your question, is you need to take this rule set and this model and you need to find how often it plays out. And when you do that, you're going to get pretty excited. And there's a lot of students in here who are excited with how often it plays out, which is pretty much every day, multiple times a day, depending on what asset class you're looking at, giving you plenty of opportunity within either the London or New York session. And with the advancement of the rule set that I gave today, I know someone like Iris is, she's going to be focused on this rule set. We're going back. We have a confirmation bias. Does it hit half standard deviation? Yes. Now we're applying it to the New York session in New York, correct? So we'd look at the negative retracement values, which appear to be a negative. This is a negative value of more than 1. And within the data set, you can look at the ADR before the ODR happened, or you can look at the ODR and the negative retracement values before the extension values began. But we have a confirmation candle on the ADR. We also have a confirmation candle on the ODR. And once we get a confirmation candle, we look for a half standard deviation. So the size right here, without me even needing a retracement grid, I can simply draw a box, say that the condition that needs to be met needs to be that we've reached a half standard deviation. So we have a half standard deviation coming off of the ODR. Just for clarity's sake, I will reduce the extension. Come on. So we get an extension. Now we run out of time. We run out of time. Except we don't, based on the rules. And what do? We bounce off of what level do we bounce off of? The S&P as it opens. What level do we bounce off of? The 0% trigger. Looks a little crooked. Come on now, buddy. We, based on the rules today, and really the rules of all time within this model, you just were responsible for. You wouldn't know that was there. Oh, you could play it off of the close based on the rules. Now that sure does look optimistic, doesn't it? A 21R trade. Come on now, kid. Let's just run this one standard, which is what we would do. TP. Now that's a hell of a movement for an open price. And one standard deviation with the close coming off of the IDR or the DR. What did we say about when the IDR and the close are the same line? What's that mean? It's a pretty strong backstop, meaning we wouldn't anticipate price to go much lower. Now we're assuming that we're waiting for that. But what if we went here? And what if we went back? What's 3 candles? 1, 2, 3, 4, 5. We'll go back to the 5th, which is part of the rule. We're going to go back 5 candles to the low. That seems pretty realistic, Kit. 5 candles off of the target, which is the 0% retracement. So we're looking for these retracement values. And as soon as this candle happens, after these retracements, this could legitimately be 925. It's right before market open. And we're only saying we're going one standard deviation. But what if you just rode this candle very quickly? You took no retracement value and you took that trade. Is that realistic? I would say it is based off of our rules. So that is also known as a low resistance liquidity run. And we bounced off of the DR. Now it's London and we're out of the session, but are we? And then, just out of curiosity, there was the low resistance liquidity run here that we talked about with this candle, which was 3R. What about this trade? What about I just copy and paste the exact same trade? I'm not even going to change the stop, although I could and I more than likely would. And I'd be basing it off of, open or the close, the IDR. Or I'd be the lowest is right here. So I would base it more or less off of this candle, even though I just hit copy and paste and it's the exact same trade and it does the exact same thing and it's playing out twice within the same day. This isn't hindsight because these are rules. And Iris will tell you, she knows about these rules because she's actually done the assignment. 12R. How much drawdown would either of these trades have? And we won't even assume that you took it at exactly that time. We'll just say that that was your planned stop loss when you took it while it was dancing on the line. So 11R today. That's more than you've probably gotten in a week, 2 weeks, 3 weeks. And they both would have won. I'm applying it off of this DR. What if I told you we were applying it off this one now? Hey, Kit, what's going on? What are you doing, buddy? What if we took the trade off of this? And what if we utilized the same logic? And we'll apply it, go back 3 candles as soon as it hits. 1, 2, 3. Take it to here. 1, 2. Flat 3R trade. Is that applicable? Does that answer questions? How you had 3 legitimate trades based off of the model today? In what was otherwise a very difficult. You watched just the 5-minute time frame. Have you reviewed DR Lens? Are you familiar with the 20 years of back-tested data and information based on a 5-minute candle? Do I only utilize a 5-minute frame? No, I trade on a 30-second chart, but I teach on a 5-minute candle. I trade on a 30-second chart, but that doesn't matter how I trade. Doesn't matter how much money I make trading. You as a student don't need more than a 5-minute candle. If you're looking at anything less than a 5-minute candle, I'd like to see your track record. How would you know to enter there after the half standard deviation hit? I mean, I don't even understand these questions. Let me go back to the rules, and I want you to simply apply the rules that are written to the model. How do I know where to enter? Is I follow the rules. What are the rules that are not arbitrary? Do you live your life with rules? Let me ask you that. Do you have rules in which you live your life in? You do. You don't have a model that has very clear defined rules that work out to make you consistent or profitable. These are the rules that will make you consistent and profitable. So what is rule number 1? A confirmation candle. What is rule number 2? A half standard deviation is reached. What is rule number 3? The retracement values have been analyzed within DR Lens. The reason we wait for a half standard deviation is because we can now look at the high or the low of the session as well as the half standard max retracement. And within that, we're basing it off the day of the week of the month, and the month of the year, which this is just a cursory thing. You're just going to look at it quickly and understand what time you would expect a retracement, what time or what level you would expect an extension. And when we say analyze multiple global sessions, you can actually be analyzing and studying this data. But even if I didn't look at any data whatsoever, I just showed you where and how you would wait for price to trigger the 0% retracement value. You would put your stop loss at the IDR, the open or close, both the IDR or the open and close, or within the high or low within 3 to 5 candles on the trigger. And if you wanted only 1R, you'd put it at 50% of the range. Your TP is 1 standard deviation of the defined range. I didn't write that. Defined range, the DR. TP2 is the based on the mode max or median DR lens data. Do you see where and how these rules apply to what I just showed you? You asked for an explanation of the rules on SPX, and I'm utilizing, you could take this half standard deviation if you want. I'm fine with that. I could add all the standard deviations on here and you can measure it based on the script. I'm showing you where and how you can do it just by drawing with logic. You just take 50% of that box. That's 50%. So you want a half standard coming off here. We don't get that until the end of the session. So you can utilize this trigger line or you can utilize this trigger line. And price worked out. This model played out perfectly once for 3R. It played out twice. I mean, this model played out once, twice, 3 times within the same day on one asset class. You had a lot of discretion and opportunity to decide which candle you wanted to pick and choose to push the button on this bright blue bold line, which is your defined entry point based on the rule set. Now, I wouldn't even have to analyze the data. I could just simply wait for this to happen. You analyzing the data is just going to make you a better trader.